Hello, everybody. As you kind of gather in, just go ahead and take a moment and put in the webinar chat. How are you brand new to investing and hard money flip or hard money loans, or are you seasoned vet? Just kind of give us, one or two line, or yeah, just one line, kind of how much experience you have as you enter, and then we'll start here in just a couple minutes. Offer moral support. Let me know when you're ready to start. What time do we got? It's 11:30. All right, ladies and gentlemen, 11:30 on the dot. We'll go ahead and get started. As I mentioned a moment ago, go ahead and post or enter the chat. There should be if you hover over the main Zoom screen, it should be something that says chat. Click on that. Just tell us how much experience you have as we get started in either flipping houses or are you brand new? Don't worry about being the first person to comment. There's a lot of people that are new to this. And then we'll go ahead and get started here momentarily. If you're looking at these two smiling faces, that's Tim and Jeff. Tim's in the wonderful plaid shirt. He's got a dad joke or two to get us started, and we'll go from there. So just a little bit of history from us. Black Label Capital was founded in 2018. Matt Podesto, Melissa Shields, our founders, founded it, and we've been in business since 2018. Matt has flipped probably at least 30 houses, but I think he did at least 20 or 30 by the time he got into it and realized that the finance side of things kind of excited him. And my name's Jeff Milewski. I'm the director of business development. And Tim, why don't you go ahead and take a minute and introduce yourself?
Morning, everyone. My name is Tim Leach. I'm the Director of Credit and Capital Markets at Black Label Capital. I just want to say thank you for taking the time to join us. This is our very first time attempting this. So thank you for bearing with us. The CGI hasn't been done yet. We haven't decided who's going to get eaten by the dinosaur. So instead, you guys are just going to have to sit and look at our smiling faces as we talk to you. We understand that your time is important and we respect that tremendously. So we want to keep this at a decent time frame. Hopefully, we'll keep you interested throughout the entire conversation. Please, Jeff referenced this, ask questions. One of the few ways that we're going to be able to know that we're reaching you is if you is getting the feedback from you and asking us questions that we can answer. So, please do that. Jeff talked a little bit about who BLC is. Again, I said my name's Tim. I've been in mortgage banking about a little over 30 years. The gray hair's earned. The last 11 years were with Mr. Cooper, where I finished with them as an underwriting manager before coming over to Black Label Capital. Jeff, do you want us to just kick off right into the agenda, or how would you like us to go from this point?
Yeah, sounds great. The first, we'll kind of just keep it going as we go through. There's the quick overall agenda. Take a minute and look at that and see if there's, try to keep the questions popping up as they're in that section. We'll do our best to answer them as we go from there. But there's the overall agenda. We won't spend too much time on it because you'll kind of see that pop up as we go along, and we'll go ahead and go to the next page. And then Tim, you want to take us off with this?
So what is hard money? And before we get into that, so that we can make sure Jeff is being honest, a couple of dad jokes. Two sheep walk into a bar. Sorry, my grandson loved that joke the other day. So what is hard money? Private versus hard money. Let's start with that. Let's kind of differentiate the type of lending that's out there. So private money, and a lot of people kind of lump private money and hard money in together. They say, well, it's all the same thing. And there's a lot of similarities, but they aren't really quite the same. There are some differences between them. Private money is basically a loan that's given to an individual or company by a private organization or even a wealthy individual. That's where hence private money. There's almost no regulation, which has a good and a bad side. And because of that lack of regulation, the borrower enjoys a lot more freedom. And one of the historical issues with private money is that the borrower has that freedom to use the loan for anything less than, shall we say, ideal purposes. Private money can include commercial trade exchanges that use barter credits, private gold, silver exchanges, local paper money, computerized systems of credits and debits, anything along those lines. So hard money is a very specific type of asset-based loan. So it is kind of next door to the private money, but not right next to it. It is used to secure real estate. So it has a very specific purpose. Most hard money loans are used for projects that are going to last a few months to a few years. Here at Black Label Capital, we tend to have most of our loans capping at about 12 months. A lot of people call hard money loans bridge loans. They kind of use that as an overarching name for it. Inside of it, we have a type of loan that's called a bridge loan. And what that means is it's a carryover. It's to get you from point A to point B, literally across the river. Hence the term of a bridge loan. Bridge loans, if we're going to be really technical, are usually used on commercial properties or investment properties that may not be in transition and they don't qualify for traditional financing. They use them at times for distressed financial properties. That's where the hard money market has changed. We really are not in that distressed financial situation lending on that anymore. It's kind of where the hard money market has moved away from that. We're no longer using Guido on the street corner who's going to break your kneecaps. We do have regulations. They are a lot more lax than on a paper loan, but they are there. It's a much easier explanation to give you between hard money and traditional financing. Hard money, our bread and butter really is doing those fix and flips construction loans, which are structured vastly different than you would see with an paper one. With paper, you're going to go and you're going to have a house you're going to buy a house for 100,000. You're going to put 20% down and you're done. That's all it is. And you have that loan for 15 or 30 years. With hard money, we're going to say, hey, you want to buy this house, you want the money to fix it up, so that then when you sell it, you can sell it for much more. So we structure the loan with your down payment, just like you would on your paper. You're going to put money down essentially for the acquisition of it. But then on top of that, we are going to loan you the money to do that work as well. So it's not uncommon with a hard money loan for your loan amount, your final loan amount, to actually be greater than your sales price. So there are, and those are the differences. Now, the processing, which we'll get into, and Jeff will cover that part of the presentation. The processing is very, very different and much simpler than on an paper loan. For those of you who've had an paper lender, feel free to raise a hand. Just drag you through the mud on your tax returns and why you didn't write that off, and what about this thing on your bank statement? There's a regular bill on your bank statement showing, and why why did you not turn a profit that year, and what was this write-off? Whoever have been, if you've been dragged through the mud like that, that doesn't happen with a hard money lender. Doesn't happen with a hard money loan. We are going to look at the property primarily, and then we're going to look at assets on it. And those are our two big things, because, in our office, we have an expression, we want skin in the game. That's where we're going to look at our risk. Borrower have skin in the game. Is there, is there a reason for him not to walk away? Is there a reason for him to complete the project? And consequently, our documentation and our processing time and purposes are much less than they would be with an paper loan. And we can do these loans where we are giving you money for future construction. let's go ahead and go to, I guess, terms and definitions, because we kind of blended into that really well. So when you get into hard money, you're going to hear some of these phrases and definitions and things. LTV. Well, LTV is LTV is LTV, be it hard money or A paper. It's going to be the same. So you're going to have loan to value. Loan to value ratio is simply what percentage of the value of the property is your loan. Easy. You'll hear that with your A paper ones as well. You know, is it an 80% loan, 90% loan? So we have LTV. We have, let me change my sheet for a second for you guys. I'm sorry. That's my fault, not yours. LTPP. Sounds a little bit different. It's really not. LTPP is simply loan to purchase price. Over 90% of the time, that's going to be the exact same thing as an LTV. Your value is going to be your purchase price. Every now and then you'll get those odd houses where somebody is just buying a phenomenal deal and they can have their value way up versus their purchase price. LTC, and this is where we're going to camp out for just a couple minutes real quick here. LTC is really the primary driving calculation with hard money loans. What's funny is it's the easiest calculation as well. So LTC means loan to cost. Okay, loan to cost. Loan to what cost? Cost of what? Loan to cost is your acquisition cost, price, plus your construction or rehab price. Okay, so with a loan to cost, we say, generally speaking, if you're doing a fix and flip loan as an example, the average LTC is going to be 85%. Here's the calculation. Everyone get a pen and paper ready. Gonna have to write a lot of down on this. 85% of sales price plus your rehab costs. That's it. So if you buy a house for 200, you spend 100 doing your rehab costs, that's 300. Your LTC is going to be 85% of 300, which is $255,000. That would be your maximum loan. Because I told you it was the easiest one. LTARV, this is one where a lot of people, they want to try and use their LTARV to figure how much money they can get. And not too many people are really relying on that. They'll use it as a backup calculation to take a look at, but we're still going to have caps on it. But we're not going to sit there and say, well, hey, we don't care about the other ones. We're going to give you it based on your LTARV. LTARV is another fairly simple one. It is loan to as repaired value. Some people call it as completed value. Same thing. It's basically your loan to what the house is worth when all the work is done. Now, I'm going to say something about this. And in one of our future webinars, we're probably going to have somebody come in and do a talk on this, on how to correctly and accurately calculate your ARV, because there is an art and a science to it. We know some people that are just phenomenal at it. They can look at the current market. They can look at the work being done on the house. They can look at properties that were available and have sold, or ones that are sitting on the market, and they're very, very good at calculating what that ARV is. It is probably the single biggest area where new people coming in don't ask for help and really should, because unfortunately, all too often we bet with our hearts. You know, they tell you never gamble and never bet with your heart, and people do. They fall in love with the property. They think it's gonna be worth so much money, and the ARV comes in way low. So it's simply a percentage of what the the final completed value will be. What people want to do is they want to say, hey, why don't you give me the loan based on that? When you run the numbers and the math on this, a lot of times, trying to loan based on only off the ARV basically means you wind up giving people a lot more money than it's worth, and then the risk factor goes through the roof. So we don't really lend just off ARV. Bridge, we covered that a second ago. What is a bridge loan? Remember the example of crossing over the river. So what we call a bridge loan inside is simply a loan that covers somebody from a point they're stuck at to bridge over to where they're not stuck anymore. You know, imagine the Donner Party running up against the river and they can't get across it. So we give them a bridge loan to get across. Examples of a bridge loan. They finish the rehab, but they just cannot get the house sold. That original loan is now due, but because they can't sell the house, they're stuck. Well, they take out a bridge loan, which is another short-term loan for 12 months. And in that time, they're actively marketing the property, trying to sell it, get it sold. So it's a way to buy more time without going into default on the loan. DSCR. There will be a test at the end of this seminar, by the way. DSCR, debt service coverage ratio. Debt service coverage ratio. Easiest way to explain this is to say it is essentially an investment property loan. Just like if you were to go down to an A-paper lender and get a loan on a rental property you have, that is really what a DSCR is. The pricing's slightly higher than A-paper. The documentation levels are just like they were with our other loans, so they're much easier for you to get done. You can do them with prepay penalties on them, 5-year, which gets your rate down to no prepay, which has your rate up a little bit higher. Here's the catch with them a little bit. On a DSCR, it lives, breathes, and dies by the rental income covering the debt. It's the end all to beat all with a DSCR loan. You have to have the rental income to cover the debt. So that's what a DSCR loan is. And again, guys, we're going a little bit fast, and I understand that. Hopefully we'll have more time. If people write back and say, hey, we have questions, we'll have time to go over some of these in detail, either with questions or maybe another seminar later on. Fix and flip. Hey, moving over that. Basic fix and flip. That's what our basic loan is. Ground up construction. This is where it gets fun. A lot of people look at these things and they say, hey, I've done some fix and flips. They're cool, but I want to really make a killing. I want to build a house from the ground up and sell it and really make a bunch of money. And that is possible. Absolutely, it's possible. We wouldn't be here in a business if it weren't possible. But with that comes a whole lot of different issues. I'm not going to get into it. That could be a whole seminar by itself. But ground up construction is essentially what it is. As with all of our loans with hard money, we do not lend for primary residences, and we do not lend to individuals. We lend to entities, meaning, no, we're not talking entities like the aliens coming to we lend to LLCs, S corps, even regular C corps. Okay. Points. When do we have these in here? So with a hard money loan, because we have greater risk, because we are doing construction money on the back end of it, because of all these things, there's two things. Everybody's gonna make money. That's the goal. Nobody does something for free. So the points and the rate will generally be higher than on an A-paper loan. And that makes sense. It's also because it's a loan. Part of the reason that rates are what they are for a 30-year mortgage is because that investor is going to be collecting that interest for 30 years through the ups and downs of 30 years. They know they're going to have that return coming to them. With hard money lending, it's a short-term loan. We go 12 months. The payment is interest only. And it's a situation where, hey, it's a short-term loan. We have to make a return. The investors have to make a return. You know, we want to get you the money to get your job done. And so the rate will be higher, and points are generally a little bit higher than on a paper loan. Most lenders out there right now for an A-paper loan are charging about 1 point. Our range is you know, a little over 2. So we're going to charge more on the points. Cross collateralization. Every time, the first time I heard this, I thought cross fertilization. I thought we were talking about plants. Cross collateralization is basically where, let's say you own 4 properties and you want to buy a 5th. What and you don't have the money or whatever reason, and so you go to the lender and you say, hey, what if you put a loan against my other 4 properties so I can buy this 5th property? It's a very simple explanation, but that's essentially what cross collateralization is. You're going to collateralize those 4 properties for your 5th, so you're crossing them to get that 5th. A guarantor is the person who is promising to repay the note. So if you have 2 people on your LLC, Bob and Marcia are on your LLC, they will both be personal guarantors for repaying this loan. You don't generally have the idea in hard money lending of non-personal guarantor co-borrowers. All of the lenders will look at that and say, if you're on the documentation of the entity, you're going to personally guarantee it. And proof of funds, pretty much what it says is verifying that you have the sufficient funds to close. And I want to go into what sufficient funds to close are real quick. So when we say funds to close, hard money lending is not regulated by Gramm-Leach-Bailey regulations. We're not regulated as a mortgage lender. We are regulated as a business lender. So we don't do a CD explaining your documents, explaining your closing costs or anything along those lines. For us, when we're looking at it, we're going, hey, you need proof of funds. We're looking at going, okay, you need your down payment, essentially what you would call your down payment. You're going to need your loan costs, which we can calculate that because that's our costs. And then we will need to see a reserve account. And that reserve account is going to be a factor, usually based on so many months interest plus a percentage of the construction budget that you have in reserve. You don't take it out of your bank. It is there for us to see that it's there. The reason we want to see that is, one, we don't want you to drain your accounts to get the loan. It's not healthy. It's not wise. And historically, it's shown that people that do that don't get the construction done. 1. And 2, because remembering, and Jeff will talk about this more, remember what a draw is. A draw is not fronting you the money for construction. A draw is reimbursing you that money. So we want to make sure that you have those funds to pay your contractors so that we can then reimburse you. Okay, Dan, we've got an English major in the group. Yes, I know we need to correct that. I saw that as well. Thank you so much. And proof of funds. What number were we on here? So our type of loan products, and hopefully I'm keeping your interest a little bit here. Short-term versus long-term. We've kind of hit this, and we're just going to touch on it again to reinforce it. Our short-term versus our long-term. Short-term is 90% of our loans. Short-term is going to be our fix and flips. Short-term financing is going to be our new construction. Long-term is going to be our DSCR. That's what it is. Short-term loans will run, we generally will do some 6, some 9, and some 12. There are lenders that go 18 months. We haven't really done that yet. And it's not, it's more of a preference issue. We can go to 18 months with an extension. And when you kind of balance out these things, instead of having all these options up front, it's kind of like the difference is going to Cheesecake Factory, where you have a 20-page menu, or going to a specialty company that does what they do very well and gives you the best food, but their menu is only 2.5 pages. We want to be that 2.5-page guy. So we can get to 18 months, absolutely, all day long. It'll be through extensions, but we're not going to have that on top of the other pricing going out there. Type of loan products, again, these are kind of talking about terms. Ground up, we do the ground ups, we do the construction loans. One of the big issues, guys, and is if you shop around, you'll hear this from other people a lot, and that is with ground up, you will have to have experience in doing a previous ground up same for same. Meaning, if you're going to do a ground up construction of a new house, you have to have completed and sold a ground up construction of a new house. Okay. We can actually finance you on a fix and flip with no experience. A lot of people can't do that, but we just can't find a market for those doing a new construction with no experience. The risk is just felt to be too high. DSCR, we just talked about that. Fix and flip, we talked about that. Mixed use, we have not covered mixed use. So what's mixed use? No, we're not saying mixed juice, we're saying mixed use. Mixed use is a property that is a combination of, that has a combination of residential usage as well as commercial usage. How many of you have seen in a lot of the renovation areas in some of the towns have these where it's commercial stores on the bottom and on the floors above it, it's apartments? Yeah, that's a big thing in a lot of the renovations, some of the cities and towns. That's a mixed use building. We will do mixed use loans. However, there are some different restrictions to them, meaning you've got to have a certain percentage of both the square footage of the building and the rental income of the building. A certain percentage of both of those has to be residential. In other words, I can't do a building that has one apartment and 15 commercial buildings in it. Just so you can keep it in your mind, and we'll go into details later, with the mixed use, they want them to slant to the side of the residential. So they're going to want the majority to be residential versus commercial. And then there's commercial buildings. That's a little difficult right now. A lot of lenders have gotten out of commercial lending. There's a multitude of reasons for it, and that's, you guys were talking about where the money comes from and why it does and when the changes comes. It's a whole other discussion to have. The issue is right now we are looking, actively seeking commercial partners. We're not doing commercial loans right now. But a commercial loan is just that. It is on a commercial property. What is a commercial property? Believe it or not, a hotel is considered a commercial property. RV park is a commercial property. Warehouse is a commercial property. A restaurant, a church, those are all considered commercial properties. An apartment complex is not. Okay. Bridge loan, we talked about the fact of that hard money loans are considered bridge loans overall in an overarching sense. However, we have a specific verbiage for bridge loans. And then transactional funding. I don't know if you guys, how many of you will have this. So transactional funding is literally where somebody wants a loan for a day. So there's between closing the first loan and then closing a second loan on that property, there's a day gap. And the transactional funding is simply covering that day. It's an extremely short-term loan. And they usually come into play with wholesalers. So John buys a house from Frank. So there's that purchase contract. And he buys it for $100,000. John then turns around and he's going to immediately sell that house to Henry for $150,000. So we have two purchase contracts there, but they can't get them to close on the same day. So there's like a day gap, and that day gap is what transactional funding covers. And that's as much as I can go into detail on that, guys. And if you ever have one, please come to us, talk to us about it. We'll walk you through it. They're kind of different. They're somewhat unique. And I'm gonna okay. So and you're almost done with me. And pretty soon, guys, get excited, be happy, because pretty soon you're gonna get to hear Jeff talking. Pitching your deal. Look, the one thing I will tell you above everything else, be honest with your lender. Be honest with who you're talking to. Hey, I don't have any experience. Hey, my general contractor is the one who has all the experience. How can I work that? Whatever is going on, just be upfront. Sometimes the answer is going to be no. But again, we would rather give you a quick no than drag things on and then find out something at the end and then have it blow up when we've now taken 4 weeks of your time. We don't want to do that to you guys. We are in this to build and develop relationships. And some of those relationships we get by simply being the one that you trust with the answers we give you. And that's what we want, guys. We want to have long-term relationships with borrowers and brokers. And we want that relationship to be built on the fact that you trust us, and that it's not always about us just getting the loan, but sometimes it's about just talking to you about it. So be upfront. Be honest with us. When you're giving us information, for those of you that are my age, if not older, probably not many of you left like that. I don't know if you remember Dragnet, the old TV show. Just the facts, ma'am. That's what we need. We just need the facts. Don't give us a lot of unnecessary thing that, you love the house because your Uncle Bob lived in the house next door to it when you were a kid, and there was a swing in the yard, and you just love that swing and you remember that house. And don't really need that. I'm glad you have that, but it's not really important to the deal. When you decide that you're going to do a loan, that you're ready to go, you're going to pull the trigger, and you're going to do it. Probably the best way to get us the information so we can get you a quote as quickly as possible, and a quote that's thorough and real, will be to use our Quick app, which is on our website. It'll say apply today. Click that button. Don't panic. Don't worry. We're not going to ask for first blood. We're not going to ask for your firstborn. We're not even going to run credit. It is basically 16 questions. And I think we've actually cut it down a little bit. It might be 14 questions. Just a few questions: property address, loan type, sales price, construction costs you're going to do on it. Basic questions. We will take those questions, and the vast majority of the time, we'll be able to offer you a quote based on that quick application, and get it right back out to you same day. Every now and then we'll have some additional questions we'll need to ask if something's unclear, or maybe if it's at the end of the day, we might get it back to you the next day. We are huge on communication, and we will have open communication with you throughout the process. We want to have open communication with you discussing rates and terms. Hey, if I give you a quote and you don't like it, talk to me. See if we can meet you halfway. See if we can come up with something we're both going to agree with. That's really what we want here. Terms could potentially change. As much as I hate this, and we try to avoid it at all costs, terms could potentially change in the process of the loan. Why? Well, you told us you had a certain level of experience, but when it comes out, that experience really wasn't there. The ARV that you were hoping for didn't come in, and it came in much lower, and we had to redo the numbers. If everything stays the same from when we gave that initial quote, it's pretty rock solid that we're going to close the way we quoted it for you, unless something changed. Okay, credit coming in lower, things along those lines. Once we finally get into, we've done the quote, you've accepted the quote, we're ready to rock and roll with this, we will do we'll do the initial approval to you. We've done the initial evaluation. With the initial evaluation, we're going to take a look at some things. We're going to look at we want to look at the loan type we've talked about. We take a look at the property location. Believe it or not, that matters. A lot of people go, hey, I'm going to go buy a lot of land way out in the country, and I want you to finance that. Generally speaking, they won't. Location matters. What's that old real estate joke? What's the three most important things? Location, location, location. And it really does matter. They want to do these things in areas that are either within the city, within towns, within cities, or very close to them. Why? Because we're not looking at financing your dream home out in the country away from everybody. The expectation is you're building or fixing up a home that you're going to try and turn around and sell or rent. And historically, what shows that the ones that make the most money doing that are those in a town or in a city. So we're going to take a look at that thing. We're going to look at your location. Again, we're going to look at the property types to make sure we're giving you a good quote on it. We're going to look at the transaction type. Is it a purchase? Is it a refi? Yeah, we do types of refis. Let's say you've owned the lot for 5 years and you're now going to build on it. That's considered a refi. We're going to look at your LTC. We're going to look at your experience and your liquidity and your credit. So our initial evaluation is going to have all that looked into it. And then the processing, which is where I'm going to hand this off to Jeff right now, is where we will get into verifying all of that and validating all of that.
So with that being said, the documents that we're going to gather, we try to keep it as simple as possible. It's not like your traditional lender, or as Tim phrased it, a paper. We don't care about tax returns, W-2s, those sorts of things. We try to keep it at minimum. And most of the documents we need are pretty straightforward. Like Tim has mentioned, we lend to an entity, LLC or corporation. We need those entity docs. Most of our clients use an LLC, so that's kind of the terminology I'll use. If you have questions on what corporate docs, we can, you can give us a call and we can go over those offline if it's a corporation. But the standard items for an entity formation, good standing, operating agreement, EIN, those standard documents are all going to be needed. If what I'm saying sounds like Egyptian to you, that's, the standard documents after you create an LLC. Obviously, we'll need a contract and a scope of work. Tim mentioned the scope of work. It's the budget. Just to kind of dive down on that, we want to know especially if you're flipping, are you going to, you put windows $5,000, or replacing one window, two window, all windows. Kind of give us a number. Also, if you're replacing the countertops in the kitchen, we want to dig a little bit into that and go, are you just replacing it with Formica, from 30 years ago, that same style? Are you doing quartz or granite? That those numbers kind of make a big difference. And as you go through the process of getting your draws, it'll make more sense to have a little bit more detail on it. Now, we don't need exact quotes from every lender or every vendor, but we just need some ideas there. And then bank statements. We're not doing the fine tooth comb like in the on a traditional lender, but we do want to see a couple of months or 3 months, and those large deposits we may ask for a letter of explanation on it, driver's license, and then if it's a ground up construction, we will probably ask for a survey and plans, or we will. And then sometimes on our flips, the title company likes to have a survey on file. It's not something necessary that we always require unless square footage is being added. So those are the standard documents that we'll need. And then final approval. What does it mean? Like Tim said on the front, the initial valuation, is the property in a good location? Does it make sense that it to be flipped? It's not out on 15 acres next to a ranch farm that has no capability of being rented. But with that being said, final approval, we get it through, we send it to our underwriting or closing team, and they review it there. And then final term sheet. Our term sheet is going to have your down payment, it's going to have our costs, and it's going to have points and any of those sorts of things. What it's not going to have is it's not going to have your title. It's just like everybody knows, whether it's your primary residence or an investment home, you can shop for your title company. If you want to use the one that you've used all the time, great. Our term sheet won't have that because that's something that you set up with there. And then normally about that same time as you get that final term sheet, you get the clear to close, and then we can, once you get the clear to close, we normally close within a day or two. Timeline considerations. The most popular question is how quickly can you close? And Tim and I have answered it 100 times. Every time we say, with a full package, we can close, this week. And anytime somebody says, well, I need to order title and the appraisal's not in. Well, as soon as I get that, I can move in. But for on average, we can close in 2 or 3 weeks if, assuming it's a pretty quick, easy deal and on that sort of thing. So, first loan, sometimes there's a little bit more questions on why you need documents or why do you need this? After we get that first one done, it's going to be a little bit quicker. We'll retain your entity docs. So we'll have that sort of stuff. And, if you're the type of person that flips a loan, every 4 months, like some of our guys do, is we just need updated bank statements and basically, and we can go from there. The next section is loan funded. So we'll skip move forward to there. Performing loan expectations. Man, the main thing is timely payments. Nobody wants to be chased down about money on paying a loan. Something that we started a while ago is we do ACH payments. It takes it online. And then renovation timeline. Our loans are short term, 6 to 12 months. Yes, stuff happens. Permits took longer, or a vendor schedule got mixed up and couldn't get there. But at the end of the day, it's we want to keep it on time and kind of going forward on there. And insurance and maturity dates. Read your loan documents. You get a copy from title at closing. Our loan documents have basically stayed the same for years and going from there. Construction draws. This is what's important. We reimburse the bill. So, as part of what we talked about a minute ago is bank statements and showing liquidity and those sorts of things. We reimburse you. And I've had people that say, hey, the cabinets were delivered. Well, we don't pay when they're delivered. We pay when they're installed, and that makes sense. And when we have an inspector go out, the inspector takes a picture, and that percentage completion is what we pay on at that point. So if you're 50% done with the flooring and the inspector comes there and says 50%, you'll get 50% of that budget. And we normally like to do it pretty quick. We don't like to hold on to it. We try to do it as quick as we can. We have a couple different systems we use. One's a little bit more automated, the other one's a little bit more traditional. But just as that inspection company comes to us or sends us the report, we try to turn it around as quick as we can. And then obviously, our wires pay out in the late afternoon, and so that's how it's set up. And sometimes your bank can take up to a day to process it. So that's kind of what the construction draws are. But it when that inspector goes out, it's a snapshot at that time. If later that day or the next week you finish, that project, it's going to cost money to have that inspector go back out. It's another fee. Loan extensions, hey, like we said, permits could be an issue, or weather. We've had quite a bit of rain, I feel like, in the last few months, and it kind of pushes people back. It happens. We generally do 3-month extensions. A couple of things that are needed for it. It's insurance paid and current, property taxes paid for, and showing liquidity. We try to make it as easy as possible. And yes, there's a fee to it. And sometimes we can, instead of doing 3 months, we might consider 6 months, but generally we do 3 months from there. And then loan repayment. How do you get out of the loan? Generally, it's either moving it to a long-term rental or a DSCR loan with us, or if you pay it off, and most of our short-term loans are simple interest and no prepayment penalty and interest only, so you're not hitting that principal to it. So that's kind of the way is to sell it or refinance it with us. And then let's go ahead and go to the next page there. Listing the property, and we kind of talked about it. Rent versus sell. Are you going to be the type that you fix the house up and you want to have that mailbox money, that that consistent money coming into your pocket every month and going from there? And then if you're going to sell it, making sure it's marketable. We have some builders that are in the same neighborhood that sometimes they'll have 2 or 3 offers before they finish a house, and the house around the corner has been listed for 4 months. It's about making sure it's staged properly, it's shown well, and that you get in partner with, if you're going to sell, you get in partner with a good realtor that's going to, price it appropriately. And I get it, every time you want to hit it out of the park, but does it make sense to have it extended if you're just making payments on it, and it's not going to sell at too high of a price. And then we'll go to the case study there, and this is actually numbers are a little bit different just because I wanted to use round numbers as we did this loan, but this is actually a house that happened in North Texas area. Our borrower bought it for about 80,000. Rehab was 60. They finished in, I think, 2 or 3 months, and they sold it for 200. They might have sold it for 205. I can't remember, but it was either 200 or 205. And so they pocketed, $60,000 or minus any transaction fees, realtors and that sort of thing. But they made, about 50 or $60,000, and it took them a few months. And this client happens to be really great at what they do. And I get it. Everybody wants to hit it out of the park each time, but it's not always about getting the $1 million deals. You could do 4 of these in a year just as easily as one of those bigger deals. And then if you have questions, go ahead and start putting those in the chats as we've gone on. And then just I see a lot of new faces or new names that I don't necessarily recognize. But if you're not following us on Instagram and or Facebook, go ahead and hit us up on there. Follow us. Our marketing director loves to post pictures of projects and show the work. And if you have a project coming up and you'd say, hey, I'd like you guys to come out and see it, if it's in the Metroplex Dallas, we'd love to come and see it and kind of see where you're at and what you're coming up with. And Black Label Capital, yes, we lend in over 30 states, but with our office being here in the North Dallas area, this will always be our biggest footprint, both the DFW area and Texas itself. So excited that you guys all came in to check this out. And I don't see any questions coming in, but there's our contact information. Obviously I'm Jeff and that's Tim. Got real easy email addresses if something pops up, or if you're like me, you leave this conversation and go, man, they talked about X, Y, or Z, and you have a question later on that you can shoot either Tim or I, and we can answer those for you. But
just dovetailing a hair off what Jeff said, because I did a great job on that. Look, guys, one of the things we want, one of the ways we've built our business and built our business, and the way that our owner started the business, was believing in relationships. And that's massively important to us. Look, we want you guys to not just go to us for one and done. We want to do your first rehab, your second rehab, your third rehab. We want to be in that wash, rinse, repeat relationship with you, where you get it done, you do it again. You get it done and you do it again. That's what we're looking for. And when we have those relationships, they work amazingly well for all of us. And it's one less thing when you're trying to do this, when you're trying to rehab a house, or you're taking that step into trying to do a new construction. It's one less thing to worry about. Hey, I've got my lender over here, Jeff, over at Black Label Capital. Man, he's going to be honest with me. He's going to be good with me. I've worked with him before. I'm going to give him the information, and we're going to go with this. And it's one less thing to worry about. And we're in the relationship building, as well as the house financing. We are really in the relationship building, and that is why we're doing this today. Was that my goodbye?
Unless you want to end with a dad joke.
I'm good with that today. We'll do more dad jokes on the next one, maybe.
Real quick before we go, we're going to have another series coming up. We're going to go over insurance, what type of insurance is needed, why is it important, not just the liability in the dwelling or rental and this and that, but also, I assume a lot of people that came today are business owners, and kind of go into that. So that'll be a few weeks out. And then after that, we're going to go over ARV. So just so you have it on the horizon. And if you're on Eventbrite or Facebook, you can click the follow and it'll publish each time we host or organize a new event. And that way you guys can stay in touch with us. And hopefully, if this was valuable to you, you can share it with people in your network, and we'll go from there.
It was a pleasure. It was an absolute pleasure talking to all of you guys today. Hope we get to do it again soon. And we have some 4 Q&As. Do we?
Drew, yes, we are doing a mixer soon. You must follow us on social media because we just had one, last month, and our next one will be next month, June 20th at Pop Stroke, 4 to 7. For those that are unfamiliar with it, Pop Stroke is a Tiger Woods inspired or owned mini golf course. They have food and drinks, and you download an app and they send your food to you or your drinks as you golf. We'll have a network mixer for that. And then I believe you can golf all night if you get too busy like I do and saying hi to everybody, and then we'll go from there. But yeah, June 20th, 4 to 7 is the next mixer.
Thank you. And guys, thank you for giving us your time of day to share this with you.
All right, everybody have a great one and reach out if you have questions.
Bye.